I find that running a business is often like baking. When you bake in real life, you can have all of the right ingredients, the right temperature, and the right mixing, but sometimes the batch of cookies just doesn't turn out. Much like baking, in real life, businesses fail for a variety of reasons. It could be the competition, maybe the products, the staff aren't performing well, but in many cases, risk is very prevalent in business. Some businesses fail when they do everything right, and it can be simply due to internal or external factors. So, today we're going to talk about the invisible force that's prevalent in business called business risk and how it impacts operations and long term planning. Hi, my name is Andrew, and welcome to the podcast episode on Andrew Talks Business. We're going to talk about risk, different types of risk, and how businesses mitigate risk, how they plan strategies, both short and long term, to mitigate risk that's very prevalent in business. So, first, let me just talk about a quick definition about business risk. Business risk is the chance that something negative happens in business, where that's internal or external, and the odds that it actually occurs. It could be things that threaten profitability, revenue, branding, reputation, etc. If it can reduce the revenue, impact costs, that's risk. I think a lot of us forget that starting a business and running a business is not like 100% certain. For example, you could take out a loan for $4,000, start a t-shirt printing business, and there are chances that the business may not work out. You could maybe print out like two sweatshirts and really risk all of the $4,000 that you put in to start the business. One of the reasons that people start businesses is the potential to make profits. For example, when I go to work, it's consistent. I know how much I'm going to make, and I know exactly the amount of hours that I predictably am going to work. But when you start a business, of course, there's a great potential to make a lot of money and a lot of profits, but that also comes with risk. There are days that you could be making lots of money, and there are days that the business is very quiet. You might not get a lot of business. For example, weather is a significant risk for businesses, especially restaurants. Right now in like Toronto, there's like a significant wind chill. So you get temperatures of -20 and -30 degrees. Do you think people are going to go to the restaurant in that weather? What about ice cream stores and shops in Saskatchewan when the weather is almost -50 degrees? So that presents risk because you don't know how many customers are going to come into the restaurant or if they're going to even go into at all. Potential for profits exists because entrepreneurs risk their own time, money, and energy into starting the business. Yes, they could make a lot of money, but there are also days that they could make no money. One of the first things I do in my junior business class is I teach about basic business definitions, revenue, expenses, and profit. And we play this game called the lemonade stand game, where we make lemonade, we choose the amount of lemons that we buy, sugar, ice, cups. We make a recipe about how much to put when we make a pitcher of lemonade and then we run the business. But there are several factors and risks that we take to start the business. For example, we don't know how many people are going to come. We don't know how many lemons are going to be spoiled because of the weather. And we also don't know if the lemonade is going to taste good. We could put in like 12 lemonades, 12 lemons in lemonade, and the recipe could turn out bad. And next thing you know, nobody comes to the shop. So there's significant risk that's prevalent in the game, especially with the weather. You could get a lot of people coming to the lemonade stand, or you could get very few people coming to the lemonade stand. And there are some days that there's a lot of profits, and some days where the business is barely making any money. So we mitigated that risk because we determined how much lemonade to make so that we weren't spoiling a lot of our product. Because in certain instances, when there's a lot of rainy weather, you're not going to have a lot of customers. So we make less and we kind of mitigate the loss of making too much lemonade. That's actually called internal risk because it comes from inside the company. If inefficient operations, weak leadership, human error, these are risk factors for a business. If we can control these risks by proper planning, training, and more efficient operations, we can reduce the amount of risk that a business has and also make the business more predictable in its operations. There are also external factors in the business. I actually made a video about this in my pastel analysis, like political, economic, social, technological, environmental, and legal factors, as in these are factors that the business cannot control versus things that the business can control, which are internal factors. So you have internal and external factors. So you have things that the business can control versus things that the business cannot control. Regardless, in a business plan, you'll often have strategies, but also plans to mitigate both internal and external risk. So you can see how internal and external risks are prevalent not only in the operations, but when you introduce a new product to market. Let's say, for example, Pizza Hut wants to introduce a new type of pizza to the market. Bringing a new type of product to market incurs risk because there's significant financial, physical, and human resources involved in making the product. You're investing a lot of financial resources, a lot of capital, and a lot of human effort into trying out this new product. There are chances that the product could go very well, but there are also chances that the product may not be successful and that you wasted a lot of money in your operations. So, all in all, there's no guarantee that the product is going to be 100% successful. There are certain factors that could limit the product's profitability, which is why businesses will have mitigation strategies. Because there's no guarantee that the product will have enough revenue to cover the costs, businesses often do things like market research and testing to ensure that their product launch is successful. For example, when Pizza Hut introduced probably cheese in the crust, they definitely tested it through a lot of market research. They probably tested their products at their headquarters and they got people to, taste the product before rolling it out to market. They'll also do things like test markets where they have a specific location to test the product. So they kind of work out all of the nitty little problems that could arise before they roll it out to thousands of stores. So, oh, the implementation of the product, how long does it cook? All of these small little factors are risks that the business is going to iron out before they roll it out to market. Now, you might be wondering, why do companies, if they're known for a type of product, introduce new products to market? Well, Pizza Hut is in a very competitive market with a lot of competitors. So not only do they have to maintain their customer base, but they try to attract new customers, do product testing, and they introduce new products to the market. Of course, there's risk, but if their product works out, if their stuffed crust is good, next thing you know, not only do you have more customers, but you have a loyal fan base of people willing to try Pizza Hut products. And this stream of customers is what makes the investment worth it. The revenues that come from the product launch outweigh the costs. So it's a worthwhile investment. Of course, there's risk, but the risk is worth it. Any entrepreneur or existing business is incentivized to bear the risk of bringing a new product to market because there's potential for future profits, and the long term value of these decisions is very positive. The satisfaction of solving a problem, or even just, for example, an entrepreneur's ability to pursue a passion, is well worth the investment of time, money, and energy. So you might be thinking, why is risk important in the business? If there's a chance that the business could lose all of the profits, why start a business? But understanding risk is necessary in the business. It's a necessary evil because it allows companies to build contingency plans, diversify revenue streams. It allows them to better manage their cash reserves and also protect against potential disasters. It's a balance between risk and reward. Of course, safer businesses are less risky, but the potential for higher future profits is much lower than businesses that choose a little bit more risk but they could also have higher returns, but they could also disappear as well. So it's really based on your risk tolerance. It's kind of like investing in stocks in real life. Of course, you can choose the safe stocks like Microsoft. You could choose safe stocks like Amazon, Facebook, Meta, Google, the big companies. Some may have lower returns than others, but or maybe you might even choose banks or even bonds for safer investments. But it's really based on your risk tolerance. You're limited to a certain amount of profits and growth, whereas you might choose a more riskier company that offers a higher potential for growth. Risk and reward are pretty inseparable. An example of a company where risk and reward was prevalent is Amazon. Have you heard of Amazon, the big e-commerce store? Jeff Bezos started this company at a time where the internet was not even well established. In the 1990s, as more people were getting onto the internet using things like dial up, going on basic web pages, Jeff Bezos found an opportunity where people can buy things online. The only real issue and a major issue is that many people were not even online or even knew about the internet. He quit a very high paying Wall Street job and basically sold books out of his garage. He wanted to start the e commerce page simply for his books first. And of course, the space is tiny. He didn't have a lot of inventory. And you're selling books at a time when there's no internet. A lot of people told him that the risk was high, that people weren't even shopping online, and you're buying so much books and inventory at a time when there simply wasn't much demand. And the business lost a lot of money in the early years and with the dot-com crisis. But the payoff was good. Amazon's now one of the biggest companies. I'm pretty sure most of the people here watching the video have heard of it, and he's one of the richest people in the world. Of course, a lot of things had to work in Amazon's favor, but by being customer oriented and focusing on a data centered approach, they were able to grow their operations and expand not just from books, but to other things like toys, like they eventually overtook Toys R Us, and they're now one of the most popular companies in the world. They made things more accessible, more convenient, and as people started to adopt the internet and found that buying things from home was very convenient, the company grew and the risk was well worth the investment. So, to sum up, you can see how risk is very prevalent in businesses, and entrepreneurs are well aware of this. They understand that in order to achieve profits, you have to risk something. And risk is everywhere, whether it's internally in the business or even external forces that affect customer demand. You can have strategic risk, financial risk, and there are chances that people may not even invest or try your business. But if you're able to mitigate your business through strategies, understand where things could go wrong, you can plan not only for the short term, but in the long term as well. Like in a lemonade stand game, if you understand where there's potential to lose profits, you can plan ahead and ensure that your business is profitable. Thanks for watching this video from the Andrew Talks Business Podcast. Be sure to like, share, subscribe, and I will see you in the next video.